Hello, and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. During the show today, we're going to discuss some steps you may be able to take to preserve your retirement savings and assets with the goal of not running out of money during your later years. A Kiplinger article, 5 Tax Strategies to Preserve Your Retirement Savings, is a great jumping off point for us today. The article first notes that you should max out your retirement and health savings contributions. Ensuring that you're taking full advantage of the contribution limits for both retirement and health savings accounts, or HSAs, is a foundational piece of many tax strategies. Work with your financial services professional to double check that you're hitting the cap for contributions to accounts like traditional IRAs, 401ks, and 403bs prior to retirement. Doing so will both increase your retirement savings and serve as a buffer against some of your income taxes. HSAs permit you to defer taxes while you're putting money aside for future healthcare costs. This year, the limit is $4,150 for individuals and $8,300 for families. You're also allowed to contribute an extra $1,000 as a catch-up contribution if you're between 55 and 65. In some cases, you may be able to keep making those contributions past age 65 if you're still employed, haven't signed up for Medicare, or started receiving Social Security. The article next recommends making Roth contributions and potentially making Roth conversions before certain tax cuts expire at the end of 2025. Post-tax retirement contributions into Roth IRAs and Roth 401ks may be an excellent way to adequately save for retirement. So, if you have the means, maxing out these contributions while you're still working may be a smart play. Roth IRAs are potentially a way to preserve some of your assets from taxes, but they can also provide some benefit before you're retired. For example, tax cuts that were part of the Tax Cuts and Jobs Act, which was signed into law in 2017, will expire at the end of next year unless Congress acts. Converting all or a portion of your traditional IRAs to Roths now allows you to pay taxes at today's rates and positions you to keep securing future tax-free income and growth on that money. Roth conversions may be a particularly effective technique if you're already retired and have a modest income. Be aware that Roths and Roth conversions aren't going to be a good fit for everyone. For example, if it's likely you'll be in a lower tax bracket during retirement than you are right now, it may be in your best interest to stick with traditional 401ks and IRAs. If you're considering a Roth or a Roth conversion, it's important to discuss it with your financial services professional first. The article next suggests deferring distributions from your retirement accounts as well as Social Security until you hit the related age limits. It may be a smart strategy to save enough money in your taxable accounts while you're still on the job so that you can delay withdrawing from your various pre-tax accounts until you're required to do so, which is currently age 73. Furthermore, if you're in good health, holding off on filing for Social Security until you at least reach your full retirement age, which is currently 67 for those born in 1960 or later, means you'll get your full retirement amount. Retiring prior to your full retirement age means your monthly payment will be lower, permanently, except for annual cost of living adjustments, which aren't guaranteed. If you wait until you're 70 to file for Social Security, your monthly payment will increase by 24%, according to Kiplinger. After you turn 70, there's no longer an incentive to keep waiting to file for Social Security. The next strategy that may help you preserve more of your retirement savings is to make charitable gifts with appreciated stock or qualified charitable distributions, which are commonly referred to as QCDS. The article explains that charitable donations may provide you with significant tax benefits while also positioning you to support the causes and organizations that are important to you. When working with a financial services professional, you can combine meaningful philanthropy, a viable tax strategy, and your overall financial strategy. Charitable giving may help you reduce your taxable income while still providing you with other benefits even after your prime earning years have concluded. To utilize a deduction immediately, consider making direct contributions to your preferred charities or organizations via donor-advised funds, as well as gifts in kind of appreciated shares. Additionally, you may also make QCDs from IRAs to the organizations that are most important to you. IRA owners who are at least 70 and a half may exclude as much as $105,000 of QCDs from their gross income each year. The amount jumps to $210,000 annually if both spouses meet the age requirement. Beginning at age 72 or 73 if you turn 72 after December 31, 2022, you may also use QCDs from IRAs to reduce the taxability of your required minimum distributions, or RMDS. The article's fifth and final tax strategy to preserve more of your retirement savings is working to provide yourself with liquidity during your initial retirement years. It's certainly a wise step to plan for those first years of retirement when you're adjusting to the new normal of no longer relying on income from your job and when distributions from your retirement accounts aren't yet required. A possible solution, according to the Kiplinger article, is to prepare your taxable accounts for withdrawals by meeting with your financial services professional to make sure your investment allocation leans toward liquid and preservation assets like tax-free municipal bonds or dividend-paying stocks. Let me note that if investing is part of your overall strategy, I strongly urge you to only do so when working with a financial services professional. At just 30 minutes, our shows simply don't provide enough time to go through all the rules and regulations that come with investing. Now back to the Kiplinger article. It explains that these investments will supply a stream of tax-efficient income and also the opportunity to trim or sell positions without worrying about market volatility, dramatically significantly reducing the overall value of your portfolio. In your early days of retirement, when you're likely nervous about your loss of income, it may make you more comfortable to have a few years of reserves and portfolio assets positioned for both safety and liquidity should you ever need it. Let me circle back to working with a financial services professional. As the article suggests, working with one who is experienced in investing and trading portfolios in a tax-conscious way can be important. For taxable accounts, your financial services professional may want to choose investments that are tax efficient and that have low turnover, while also being mindful to actively harvest tax losses to offset capital gains to lessen your overall tax burden. The article adds that less tax efficient investments may be better held in retirement accounts, particularly post-tax Roth accounts. During retirement, asset location may be as important as asset allocation. If you have any questions about the new generation retirement system, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.